Hey everyone, welcome back to the channel. Today we're diving into some interesting news that you absolutely don't want to miss. A 15-year fixed-rate mortgage is a home loan with a 15-year term, which means its payments are designed to zero its balance in 15 years. And it's a fixed-rate mortgage, which means its interest rate won't change during the loan term and neither will its monthly payment. However, if the payment includes an additional amount for property taxes, homeowner's insurance, or mortgage insurance, these amounts can change. The advantage of a fixed interest rate is its predictability. When your rate and payment stay the same, you can budget more easily year after year. The disadvantage is that if interest rates fall, your loan won't change. You'd have to refinance to obtain a better mortgage rate. Because loans with 15-year terms are less risky for lenders, they tend to have lower interest rates, about 0.5 to 1 percentage point lower than 30-year mortgage rates. The current spread between 30-year and 15-year mortgages sits at 81 basis points, a full 25 basis points higher than the long-run average spread dating back to 1991, says Ralph McLaughlin, senior economist at Realtor.com. Though there is not a perfect correlation, over the past 2 decades the spread between the two has tended to rise and fall with mortgage rates. This could be a silver lining for homebuyers in a high-rate environment, as the potential savings of choosing a 15-year over a 30-year mortgage increase when rates are at their highest. Even though you're paying off your loan twice as quickly with a 15-year loan, your payment won't be twice as high. For a $400,000 home loan with a 6% interest rate, your monthly principal and interest payment would be $3,375 for a 15-year term and $2,398 for a 30-year term, $977 more. And you'd save nearly $226,000 over the life of the loan. But remember, 15-year loans have lower interest rates. For a 15-year loan with a 5.25% interest rate, your payment would be $3,216, $818 more. You'd save about $284,000 in total interest. What to expect with current 15-year rates? 15-year fixed mortgage rates, like 30-year rates, depend on a number of factors, and some are more predictable than others. However, experts can offer a general idea of the direction 15-year mortgage rates will likely take in the near future. Fixed-rate mortgages, including the 15-year mortgage, are loosely tied to the 10-year Treasury yield, which is influenced by various economic and geopolitical factors, says Mark Fleming, chief economist at First American Financial Corp., which specializes in title insurance. Inflation and labor market conditions are two of the most significant factors in today's market, and they will drive movements in the 10-year yield and determine the size and pace of the Federal Reserve's rate cuts. As the Fed continues lowering rates, we are likely to see a modest decline. For more update, please like and subscribe this channel.